Hello everyone, and welcome to today's Crypto Headlines. I'm your host, and I'm here to bring you the latest, most valuable, and fascinating insights from the cryptocurrency market. In today's program, we'll delve into the potential threat of quantum computing to blockchain security, the latest investment moves by major institutions, and the evolving global regulatory landscape. Each piece of news is crucial for your investment decisions. Let's together gain insights into the market and seize future opportunities. First, let's address a topic that could reshape the future of the crypto world, the potential threat of quantum computing to blockchain security. A new report from B1e Labs indicates that future quantum computers could break the cryptographic foundation securing trillions of dollars in crypto assets. The report highlights that newer blockchains using the EDSA signature scheme, such as Solana, Sway, and Near, are structurally better positioned to withstand quantum threats. However, older chains like Bitcoin and Ethereum, which rely on the EDSA system, face deeper cryptographic and logistical hurdles to implement post-quantum defenses. Kostas Chakias, co-founder and chief cryptographer at B1e Labs, stated that as more corporations and governments establish Bitcoin treasuries, the pressure to meet post-quantum security standards is growing. He mentioned that agencies worldwide have issued mandates that classical algorithms like EDSA and RSA must be deprecated by 2030 or 2035. This means that if your blockchain supports sovereign assets, national crypto treasuries, ETFs, or CBDCs, it will soon be required to adopt post-quantum cryptographic standards for long-term credibility and mass adoption. Ahmed Banafa, a computer science professor at San Jose State University, warned that while quantum computers are not yet powerful enough to pose an immediate threat, now is the time to prepare. He noted that Bitcoin would need to implement a hard fork to adapt to new cryptographic methods, involving changing wallet addresses, migrating funds, and handling associated complications. However, Banafa believes the likelihood of such a hard fork is small, likening it to Ethereum's split into Ethereum and Ethereum Classic after a 2015 hack, suggesting a similar division could occur in Bitcoin. He further pointed out that with the vast number of Bitcoin and Ethereum wallets, implementing upgrades would be a significant challenge, and if users don't upgrade or secure their accounts, they could pose a risk to the network, potentially leading to fund losses. Interestingly, the B1e Labs report suggests that if Bitcoin had used EDSA from the start, even Satoshi Nakamoto's wallets could be made quantum safe. Yet, Banafa also emphasized that in 2009, when Bitcoin launched, quantum computing wasn't on the radar and SHA-256 was assumed to be sufficiently strong. Next, let's look at the latest movements from institutional investors. MicroStrategy, the world's largest publicly listed Bitcoin holder, has seen its stock underperform recently. Data shows that MicroStrategy, MSTR, shares have fallen over 14% in 2 weeks, closing below the 50-day simple moving average. This downturn has led to the strongest demand for downside protection on the Bitcoin holding company's shares in months. According to Market Chameleon data, the one-year put-call skew, the difference in implied volatility between call and put options expiring in 12 months, rose to 3.6% on Wednesday, its highest since April 17th. This indicates that options traders are willing to pay a much higher premium for downside protection or are betting more aggressively on a decline in MSTR's stock price. MicroStrategy has aggressively bought BTC as a balance sheet asset for 5 years, currently boasting a coin stash of 628,791 BTC, valued at $74.7 billion. However, despite the company's strong stance in the cryptocurrency space, its stock price has been struggling recently. Now, let's turn our attention to the latest developments in global cryptocurrency regulation. Bolivia's central bank recently signed a cooperation agreement with El Salvador's digital asset regulator, seeking assistance in building a local digital asset ecosystem in Bolivia. This agreement marks a significant step towards developing a legal and technical framework for cryptocurrency adoption in the Andean nation. Under the terms of the newly signed Memorandum of Understanding, the Central Bank of Bolivia, (BCB), and El Salvador's Comisión Nacional de Activos Digitales (CND) will collaborate on a broad range of crypto policy initiatives. The cooperation includes joint work on blockchain intelligence tools, regulatory frameworks, and risk analysis models, taking immediate effect. This move reflects the rapid acceleration of crypto usage in Bolivia. According to figures released by the BCB, digital asset transaction volume grew sixfold from $46.5 million in June 2024 to $294 million in June 2025, following the passage of Decree No. 082/2024, which authorized broader use of cryptoassets across the country. The new agreement draws on El Salvador's experience as the first country to adopt Bitcoin as legal tender and build a formal digital asset regulatory system. El Salvador's CND, established after the 2021 Bitcoin law, oversees the authorization of token offerings, the registration of digital asset service providers, and the supervision of crypto-related platforms. BCB Acting President Edwin Rojas Yulo and CND President Juan Carlos Reyes Garcia signed the agreement in La Paz. Both institutions will share best practices aimed at supporting Bolivia's goal of building a transparent, inclusive, and well-regulated digital asset ecosystem, particularly for populations underserved by traditional finance. Next, let's turn our attention to Ethereum, the heart of the digital world, which just celebrated its 10th birthday. Since its inception in 2015, Ethereum has evolved from an experimental smart contract platform to the second-largest cryptocurrency by market capitalization. Over the past decade, it has faced numerous challenges and continuously adapted. Industry leaders from Consensus, Coinbase, Redstone, and Optimism are optimistic about Ethereum's next 10 years. Molesh Pai, chief economist at Consensus, predicts that within the next 5 to 10 years, Ethereum will transition from the world's leading smart contract platform to the foundational layer of the future global economy. With growth driven by asset digitization, starting with stablecoins and expanding to higher-risk assets. Justin Kenna, CEO of GameSquare, believes Ethereum is becoming the financial and cultural backbone of the Internet, powering everything from global payments and asset management to entertainment IP, gaming economies, and digital identity. Marcin Kazmierczak, co-founder of Redstone, foresees Ethereum evolving into the foundational layer for institutional finance and real-world asset tokenization, with significant scalability improvements through Layer 2 development. Sam Mackingvale, head of product at Optimism, envisions that over the next decade, all large enterprises will move on-chain, with most vertically integrating their infrastructure on top of Ethereum. Nemel Dalal, head of developer platform at Coinbase, emphasizes that Ethereum's long-term success hinges on usability and its builder community, believing it will form the basis for entirely new use cases, such as AI agents transacting on our behalf and richer on-chain social communities. In summary, Ethereum is transforming from an experimental platform into a foundational layer for real-world assets, enterprise systems, and everyday digital interactions, aiming to become an indispensable yet invisible infrastructure in the global economy. Next, let's focus on the latest developments from the U.S. Securities and Exchange Commission, SEC, regarding crypto ETF approvals. The SEC is gradually easing its approval process for crypto ETFs, largely due to new listing standards centered on derivative markets. According to recent exchange filings, the SEC now permits cryptocurrency ETFs as long as their futures contracts have been listed on either Coinbase Derivatives or the Chicago Mercantile Exchange, CME, for at least 6 months. Bloomberg ETF analyst Eric Balchunas described this new rule as a pretty big deal, as it effectively opens the door for ETFs on approximately a dozen altcoins, many of which already had high approval odds. He noted that any coin with futures tracking it for over 6 months on Coinbase Derivatives Exchange would be approved. Balchunas believes that while CME futures are valid, Coinbase Exchange's derivatives marketplace covers more coins than CME, making Coinbase the more convenient option. This move also follows the SEC's recent approval of in-kind redemptions for Bitcoin and Ethereum ETFs, further aligning with traditional financial infrastructure and paving the way for more complex crypto products. However, the path is less straightforward for meme coins and less established digital assets. Balchunas emphasized that assets like Solana-based Bank or Trump coin, which lack active futures markets, would require a more complex route through the Investment Company Act of 1940, the 40 Act, dubbed the $SSK maneuver. ETF analyst James Seifert suggests that the SEC is outsourcing some of its decision-making, as the proposed listing standards do not mention market capitalization, liquidity thresholds, or token float requirements, implying that everything currently hinges on the futures market. Finally, let's turn to news about corporate cryptocurrency holdings. XDO, a publicly traded company focused on Bitcoin, announced on Wednesday that it has become the largest publicly traded holder of the network's native token, TO. According to its release, XDO holds a total of 41,538 TO, valued at $15.8 million at current rates. The company also stated that it still possesses a substantial amount of cash allocated for further purchases of TO. This holding surpasses the 29,899 TO recently acquired by TO Synergies, TOX, which was valued at $10 million. Korea Samaru, CEO of XDO, said, "The TO treasury gives us immediate economic exposure to Bitcoin and the fuel to stand up validators that generate reliable revenue." She added, "Our goal is simple: build core infrastructure, earn sustainable cash flow, and compound value alongside the Bitcoin network." Samaru previously founded and served as CEO and chairman of the crypto exchange WonderFi, which was later acquired by Robinhood for $180 million. XDO further explained that the TO treasury will be instrumental in expanding the company's validator operations and developing infrastructure for the Bitcoin ecosystem. The company also noted that by staking its TO holdings to the Bitcoin root network, it is earning an annual yield of approximately 10%. Bitcoin operates at the intersection of AI and cryptocurrency, functioning as a platform designed around incentive mechanisms. Users contribute intelligence to improve AI systems, receiving TO tokens based on the utility of their input. The platform is open access, facilitating permissionless coordination of AI development. Alright, that concludes today's crypto headlines. From quantum threats to regulatory implementations, from institutional movements to technological innovations, the crypto market never stops its rapid pace of development. Please continue to monitor market changes and invest prudently. I wish you successful investments, and we'll see you in the next episode.